why you need to free yourself from what I call the IRA 401k tax trap. Do you know that most Americans don't realize if they're savers that they're likely going to be in as high or higher tax bracket when they retire than they were in during their earning years? And most did not see that coming. It's because many Americans don't have the deductions anymore. They pay off their house, the kids are gone, they're not contributing money to IRAs or 401ks anymore in retirement. If they were a business owner, they sold their business, so they don't have those deductions anymore, and Congress keeps raising taxes. So in this episode, I'm going to show you why you may want to consider freeing yourself from the IRA 401k tax trap sooner than later. Because deferring tax is procrastinating tax, and that usually doesn't turn out well, and it will not turn out for you. It's actually compounding your tax if you continue to defer, postpone, take RMDs, required minimum distributions. People are shocked when I show them how much tax they're going to pay by thinking they're saving tax by continuing to defer. So get ready. I think you're going to be blown away with the insights you gain in this episode. Because at retirement planning is something totally different than what most Americans did for retirement. Okay, most Americans for retirement, I think, are duped into putting money into traditional IRAs, 401ks, 403bs, 457s, tax deferred qualified plans. Okay, being told you'll likely be in a lower tax bracket when you retire. Now, if you're a saver, and you save 6, 10, 12, 15% of your income, and the smart people, the reason why they accumulate $1 million or $2 million or $3 million or more in their nest eggs, it's because they're saving a serious percent of their income. I'm shocked how many of them, as savvy as they are with saving, they all of a sudden hit retirement and they're in as higher tax bracket as they were ever in during their earning years, and they never realized it. And so I'm having to cure that situation. If I were a physician, most of my life, I think I've been curing an uneasiness. See, when you're not at ease physically, we call that dis-ease. There's a lot of people that when they see how much tax they're going to pay at retirement, and that their net spendable income to buy gas, groceries, prescriptions, golf green fees is only about 65 to 70% of what they thought their income was going to be, because basically the government has had a permanent tax lien on these IRAs or 401ks. And I don't think taxes are going to go down in the future, so they begin to realize maybe this wasn't the smartest way to go. And so I have to cure that tax dis-ease, because they realize that and inflation will likely cause them to outlive their money, in addition to market volatility, okay? And so I have realized as a retirement planning specialist for 5 decades that there are 3 big dangers that cause most retirees to outlive their money. Taxes, inflation, and market volatility. Now, inflation is like a hidden tax, and it affects everybody, especially the middle class and the lower income. Now, to be honest with you, there's a lot of Americans that never do learn to live on less than what they earn. They are what we call strivers. They're financial jellyfish. And so this video is not for them. This is for those of you who are what we call arrivers, who have disciplined yourselves to live on less than what you earn, and you sock away money. You understand compound interest. You understand tax-free, or at least tax-deferred accumulation. But maybe you didn't understand the full value of tax-free versus tax-deferred, okay? Most Americans, unfortunately, accumulate the vast majority of their money in taxed as earned banks, credit unions, mutual funds, and what have you. And do you know that a dollar doubling, 20 periods, a dollar doubles to 2, 4, 8, 16, 32, that'll grow to $1,048,000 if you don't have to pay tax as it grows. And so a lot of people with tax-deferred IRAs or 401ks go, yeah, I'm smart. A dollar doubling 20 times goes to $1,048,000 because I put it in an IRA or 401k. Well, that $1 million is not all your money. because the government has been using you as their savings bond, and they've been planning on taxing you on the back end of those IRAs or 401ks when you retire, okay, when you have the money. When people say, well, who does the government go after for tax revenue? It's simple. The people who have the money. Who has the money? Savers. And so they almost get penalized for saving, okay? And so, but they think, well, I have $1 million nest egg. Look at me. And I'm going, well, that's not all your money. That's why many people who had come to me as a retirement planning specialist, I would say, when you come in for your first appointment, would you please bring your after-tax IRA 401k statements? Now, I knew they didn't have them, but I would look for their reaction and they go, after-tax? I don't think we get after-tax statements. Okay, I'll calculate that for you. And so if they accumulated $1 million, I'd say unfortunately only about 700,000 of that is your money. The other 300,000 belongs to the government, or sometimes for higher income people, it's in California, it's 40% belongs to the government. Or another way to look at it, if you had $1 million nest egg, and if you were to take out 10% a year, if that's what you were earning, most Americans who have their money in the market at retirement, heaven forbid, are only averaging 4%. Did you know that? That's what precipitated the 4% rule. So $1 million nest egg only generates 40,000. Let's say you're pulling out 100,000, or let's just go to the middle. Let's say 7.5%. If you have $1 million in an IRA or 401k and you're earning 7.5% interest, that's 75 grand a year that you can theoretically pull out and not deplete your $1 million nest egg, right? Wrong. Okay. See, 75,000, first of all, you pull out 75,000, and between federal and state tax, a lot of Americans, 41 out of 50 states has a state income tax, so it's usually around a third that a lot of those savers pay in tax. In California, it's higher, for example, but so you pull out 75,000, you pay a third in tax, 25,000, you net 50,000 to buy gas, groceries, prescriptions, and golf green fees, okay? So only 50,000 is yours. If you pull out 75, but you need 75 to buy gas and groceries, you have to pull out, 50% more money in a 33% bracket, okay? If I need 100,000 net, I need to pull out 150,000, 50% more in a 33% bracket to net that. Now, the reason I'm talking about this is because if you had $1 million nest egg and you knew you could pull out 10% without depleting that, but if it was tax-free instead of just tax-deferred, you only have to pull out 100,000 to net 100,000. In an IRA or 401k on the back end, okay, during the harvest year. So when I use vernacular like harvest, I'll use this metaphor. If you were a farmer and you had the choice of buying your seed that you're going to plant in the springtime, and you don't have to pay tax on what you buy your seed for. And you plant it, you irrigate, you cultivate, you work hard, and in the fall you harvest your crops, and now you agree to pay tax on what you sell your harvest for. That's a traditional IRA or 401k. You get a tax break on the seed money, but you agree to pay tax during your harvest. Now, if you agree like most Americans do, when I ask audiences, how many of you think that taxes in the future will likely be lower? I get nothing but crickets, okay? Well, how many think taxes will be the same? A few hands go up out of a couple of thousand in an audience. Well, how many think that they're going to be higher? And a sea of hands goes up, and then I ask the question. If you're convinced that taxes in the future will likely be higher, why have you been postponing, deferring, procrastinating, paying tax, and you let your IRA 401k nest egg grow to some future perceived unknown advantage, and now you've got a huge nest egg, hopefully, and you've put it off until you're going to be in a higher bracket? That doesn't make sense. And they just go, oh my heavens, I've just been busy working. And so I have to free them from that trap, because they know they're going to be paying tax the rest of their life if they get duped again into defer till age 72 or 73 and then take RMDs, required minimum distributions, which is probably the worst advice for most Americans. That doesn't save tax. It makes the government more money because it keeps deferring. And I can prove to you mathematically that if you follow that advice and if you didn't need the money, but you're told by your financial advisor, defer to age 72 or 73, and then take RMDs, and I calculate the tax you will pay with RMDs out to your life expectancy, your spouses or partners, and then to your children, you'll be flabbergasted how much tax that will compound to. It'd be better to get the taxes over and done with. When you ask an accountant, what can I do to save taxes this year? That's very myopic. It's very short-sighted. Well, the accountant's going to say, well, then don't take out any money out of your IRAs or 401ks except the required minimum distribution. Well, that's the lowest amount of tax in a given year. That doesn't save tax over the long run. Does that make sense? So you've got to look at the big picture. This is why we created strategic rollouts. And so if you have a $1 million nest egg, my favorite vehicle is totally tax-free. It is a property structured max-funded IUL. But most IULs in America are not structured to be deemed what I call a laser fund, the title of my most recent best-selling book. Less than 1% are deemed to do that. But why is that my favorite vehicle? Because when I say it would be far better to have the harvest of your retirement savings be tax-free, people immediately go, oh, you're talking about a Roth. No, I'm not. Now, if you've watched very many episodes on this channel, maybe you've heard me say, I've never owned an IRA or 401k. Yep, I never will. But I've never owned a Roth, IRA or 401k, and never will. Roths only have two advantages, okay? Your money accumulates tax-free and you can access it tax-free. You fund a Roth with after-tax dollars. They were introduced in 1997. Why? Because the government was hard up for tax revenue. And Senator Roth said, hey, there's a lot of smart Americans that are realizing they're not going to be in lower tax brackets. Savers are not in lower tax brackets. So it'd be better to pay tax sooner than later. And so they could do a rollover to a Roth, and that triggered tax at lower account values at today's lower tax rates, rather than thinking tomorrow's tax rates are going to be lower. Most Americans realize they're not because of irresponsible government spending, printing of money and everything. And so the Roth, the government, it was a step in the right direction, but there's still too many strings attached. I'll explain that in just a second. But they did it for the government. The government wanted, and they got a windfall of tax revenue because a lot of people rolled money over to a Roth, and that triggers tax, and that benefits the government, okay? So they did it for them, not for us. Now, why is a laser fund better than a Roth? Because laser funds, a property structured max funded IUL, I've been able to average net cash on cash rates of return over 20, 30-year periods ever since 1980 in excess of 9.6%, in excess of 10%. Every $1 million I accumulate in one can generate a 10% payout without depleting principal if you rebalance every year, which I talk about on this channel, okay? And so $1 million nest egg can generate $100,000 tax-free. An IRA or 401k, to have $100,000 net after tax, I have to pull out 50% more money. And if I do that, if I have to pull out $150,000 to net the same spendable income, $100,000, $1 million nest egg will be gone, drained dry in 11 years. Going back to my first example at 7.5%, do you know the average return of the S&P 500 from the turn of the century, the year 2000, let's say just till 2015, was 7.5%. And you'll hear financial gurus on TV say, well, 7.5% is not bad. Well, the fact of the matter is, if you pulled out $75,000 a year and you retired in the year 2000, what happened in 2001 to 2003? After the 9/11 terrorist attacks, the market dropped 40%. If you had retired just previous to that, and you started pulling out $75,000 a year, I don't care if the average return in the next 15 years is 7.5, you retired at the wrong time. And those people who pulled out $75,000 a year, even though they averaged 7.5%, 15 years later only had 98,000 left out of their million. And yet, if you just flip those years, okay? If you retired and the year was like 2015 and then the next year of retirement was 14, the average return is still 7.5%, but you would have still had over 900,000 out of your million left. That's called the sequence of returns, because average rate of return doesn't mean anything. That's why you want your money out of the market, okay? You need to protect your IRA and 401k monies from the negative impact of taxes, inflation, and market volatility. And you do that by getting it out of the market and you put it into something that's going to be totally tax-free. Why is a laser fund better than a Roth? Because it's been tax-free in the Internal Revenue Code for 110 years counting. And there's no strings attached. If you make too much money, you can't even participate in a Roth. That's why many savvy CPAs call the laser fund the rich person's Roth. You don't have to be rich to have one. You can set one up for $500 a month, okay? But many savvy people set up a laser fund because it's tax-free. You accumulate it tax-free, it gives you tax-free income. But I can also put in a huge amount. If I'm a business owner, I can set one up to accommodate $300,000 a year. A Roth only allows you to put in a certain dollar amount at a certain percent of your income. If you don't use that room in a given year, you lose it forever. In a laser fund, if I make one, design it big enough to hold 300,000 and I only put in 30,000, that's okay. I can make up the other 270,000 anytime I want in the future. It's way more flexible and it can accommodate more money. But if I put in 300,000 you can't do that in a Roth unless it's a rollover, and Biden's trying to do away with that. That's who is presently the president as we're recording this episode. But if I were to put in as much as 300,000 into a Roth from a rollover, and I wanted to tap into some of that, I can't touch that for 5 years or before age 59 and a half without a 10% penalty. If I put in 300 grand into a laser fund and 30 days later I need 200,000 of it, I can access it. There's no tax, there's no penalty, okay? And I get to use indexing where I can participate when the market goes up, but when the market goes down, I don't lose because my money's not in the market. Most Americans make the mistake of leaving their money in the market. Wall Street was not designed to create predictable income. But laser fund, when you ultimately pass away, it blossoms. So if I died tomorrow in an accident, I'm 72. Every million I might have in a portfolio of laser funds would double to about 2 million and transfer tax-free to my heirs. There's not a Roth around that will do that. So why wouldn't I have that? People say, well, how much does that cost? Well, nothing's free, but that doesn't cost me anything. It's being paid for with a minuscule portion of money that most Americans shell out in unnecessary tax on IRAs and 401ks. I could go on and on, folks, but if this is intriguing you, I would recommend that you search other episodes, click on this next episode that shows up, or go directly to laserfund.com, laserfund.com. And you can claim a free copy of this 300-page book that's been flying off of our warehouse shelves and off of the Amazon website. And I'll tell you what, if you go to laserfund.com, I'll pay for the book. It retails for $20 on Amazon or more. But you contribute a nominal amount towards the shipping and handling. And I will pay for the book. I'll fire out a hard copy to you via priority mail. Now, when you're in there claiming a free copy of this 300-page book, if you like to listen and learn or watch and learn, there's audio and video formats, but you can also schedule an appointment to talk to an IUL specialist. I've trained over 5,000 advisors, and I would say that the vast majority of advisors in America do not know how to structure one like I talk about in this book. So if you want to just find somebody immediately who has been trained, you can schedule a consultation with somebody, no cost, no obligation, to see how a laser fund may be structured for you, and you'll see why it knocks the socks off of an IRA or 401k, especially at retirement, instead of the pathetic 4% payout most advisors want you to take if your money remains in the market. So this is not about me, this is about you and your brighter future. So claim your free copy now, and we'll see you on the brighter side of your financial future.